Hi, everybody. Welcome, and thanks a whole bunch for having me. I really appreciate your time, and I'm going to try and give you a really great 45 minutes of information, so you appreciate being here too. Once again, my name is Dan Passarelli of Market Taker Mentoring. We're going to talk about our trading plan, the MTM Trading Plan for 2018. Before we get started, I want to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by calling 1-888-OPTIONS. Also, I'd really like you to enjoy this presentation today, so I'm going to shamelessly bribe you. I'd love for you to download my ebook at markettaker.com. It's a free ebook to you called 3 Secrets to Making Money in Any Market with Options. All right, so go ahead and at your convenience, maybe not during the webinar today. We've got a lot of great speakers today, so maybe hold off or write that website down. Okay, so here's what I'm going to reveal today. I'm going to talk about the MTM Trading Plan for 2018, and integrated within that it's an explanation basically of the strategies most likely to work in the anticipated environment. All right, so what worked in the past? This is this is a long time ago. I don't know when this is, 1998 or something. The trading pit of the CBOE trading floor. There's me. I don't look like that anymore, fortunately. Well, fortunately or unfortunately, I look like this now. But the point is, the strategies that I was using back in 1998 down on the trading floor are the strategies that I'm still using today. They're time-tested strategies, but they kind of ebb and flow, you know? When market conditions change, we have an arsenal of different strategies. I mean, that's the beauty of options, that we have an arsenal of a whole bunch of different strategies, and we can kind of pick which ones are working best in the market, market environment, and use them. So they're all sort of classic strategies, but we kind of pick and choose which ones are best for right now, and maybe tweak them just a little bit. These are universal strategies. This is excuse me, this is, here's me and John Kamisik, there's me and John too, when we were invited out by the Chinese government last year and the year before and the year before that to teach them these exact same option strategies that I'm teaching you guys here today. So they're timeless, they're classic, they're universal, they work all over. And I just kind of want to set some expectations here too. Option trading is not really about predicting the underlying stock price. I know. Wouldn't everybody here in this class just love to know, to get tomorrow's newspaper today? Wouldn't you just love to know where Apple and Amazon and Tesla and the S&P 500 is going to close tomorrow and the next day? If you knew that just one day, you could be a billionaire, right? Like, forget about this. Oh, hey, look, I made $1,000. I mean, you would take all your money, mortgage your house, sell your wife and kids, whatever it is you have to do, borrow money, get as much money as you can, and make the bet that you know is going to win. But the fact is, we don't know what bets are going to win. And so we do our best at managing the uncertainty of the market, and admitting to ourselves, hey, look, you know, it's like Socrates. The only thing I know is that I know nothing. You know, we don't know for sure what the market's going to do. It surprises us often. So what we do is we use quantifiable statistical measures to predict potential profits and optimize risk reward. It's more a statistical endeavor. We're basically have the mindset of a casino instead of a gambler. And that's how traders make money in the long run. Okay, so as far as 2017, We've all been there, done that, unless you just started trading within the last couple of weeks, which is great. I'm glad you're here if that is the case. But for those of us who were trading in 2017, S&P was up 20%. Booyah. Bitcoin was up 1,400%. Okay, I guess I would have rather had my money in Bitcoin, but maybe not this past couple of weeks. Interest rates are higher, which I think is a welcome change for everyone. Unemployment is low. Tax bill passed. That really was basically the biggest news coming out of last year, wasn't it? Market rallied for months and months in anticipation of the tax bill passing, and then when it passed, guess what? It rallied again, of course. It was buy the rumor, buy the news. And volatility has been very, very low, and it still is very, very low. All right, now let's talk about this thing about volatility here. In this presentation here, I'm going to give you some shortcuts, some easy ways, some ninja tricks, but it does all come down somewhat to knowing some core fundamentals. The more you learn, the more you earn. Trading is an intellectocracy, the smartest rule. So in option trading, you need to know some stuff. Now, you don't need to know, you don't need a PhD. I know a whole bunch of really successful traders that don't have a bachelor's degree, but they know some core bits of information. And one of the most important bits of information you need to know as an option trader is you need to understand volatility. Now, for those of you who are new to option trading, excuse me, for those of you who are new to option trading, you might think, oh yeah, I understand volatility. It moves up and down a lot, it's volatility, like Bitcoin. And you're half right. That is one of the two types of volatility. It's called realized volatility. It's just how much the stock has moved around lately. We don't know what will happen in the future, but we can actually look at a chart of volatility and put a number on it, see exactly how much you moved around lately. We can look at the annualized standard deviation of a stock or ETF or what have you. So that's called realized or historical volatility. Now, the other type of volatility, though, this is the important one. You're not going to succeed very long as an option trader unless you deeply understand implied volatility. Implied volatility is basically, in lay terms, how cheap or expensive options are. Simple, right? Now you might think, well, wait a minute, hold on a second. What does that have to do with volatility? That's like price. Like, I don't know about this. This is, this Passarelli guy, he's off his rocker. Well, no, that's not really true. Well, actually, that last part may or may not be true. However, how cheap or expensive options are deeply integrated into the concept of volatility. There are many pricing factors that influence the price of options. If we're talking calls, if the stock goes up, you make money. Stock goes down, you lose money. As time passes, options lose money, all else held constant. But then this is a third factor, implied volatility. When volatility is expected to be higher in the future, what do people do? Well, they buy options to hedge. That's the economic purpose to options. That's the reason why the SEC is glad to let you use this amazing risk management tool. You can buy puts to hedge or collars, or there's a number of different strategies. Puts are probably not the best one, but they're the easiest one to understand. So therein lies the connection between volatility and pricing. When volatility is expected to be higher, people buy options, and that drives the price up. When the market's really slow and boring and we don't expect any surprises, people sell options to generate income. Price goes down, put downward pressure on pricing. So we can also look at a chart of implied volatility, and that becomes a trader's best friend. All right, so hold that thought. We're going to talk a lot more about that. Here's the strategies that we over here at Market Taker are watching this year. We're looking at new covered call and cash. We're looking at a new covered call and cash secured put profile. Covered calls, cash secured puts, probably one of the first things that you learn. They're great for investors. Traders maybe would do something different, like credit spreads with caveats, and maybe opportunistic, trades, shorter term trades. So look, me, I'm a trader, I'm an investor. I've been both since I first got my membership down on the Chicago Board Options Exchange trading floor in the late 90s. Been doing this 25 years. I look at both. I look at the investing and I look at trading. So investors, I'm going to give you sort of the high level concepts of what I'm personally doing, and we at Market Taker are teaching our students in our group coaching class. This is what we're looking at. Investors selling covered calls on ETFs that are owned. Now, that's a classic, simple concept. It's got some nuances right now that you need to understand. Otherwise, you can get run over and you can end up in trouble in some cases. And then selling cash secured puts at 50% of the portfolio's notional value. So you have a $100,000 portfolio. You're selling, maybe 2 SPY cash secured puts. Notional value means like the monetary value, or the monetary value that an option contract represents. So if I buy a 100 strike call on a stock, the notional value is $10,000. I'm controlling the rights on $10,000, right? So that's the investor plan, high level. I'll drill down in a second. And traders selling credit spreads when volatility is conducive and trading intermittent opportunities. So this is tricky. I'm often told by people that, the only way to make money is by selling options. And to be fair, that's what I do most of my trading with. It can be a great way to make money, but it's not without its trickiness. Because sometimes, there's a reason why people say selling options is the best way to make money. That's because historically, since 1987, there's been what the academics call a risk premium. The academics and some professional traders call a risk premium in options. And the idea is that if an underlying stock moves at a 30 volatility from now until the next 30 days, the 30-day option would trade at a 30 implied volatility. And if you bought a straddle at a 30 implied volatility and the underlying does indeed move at a 30 volatility, you expect to break even. But that's not really what goes on in the market. Implied volatility has existed above historical volatility from 1987 until the last several months, until the last few months. We're seeing the risk premium shrinking. And in some cases, we've seen the risk premium disappear altogether in some names. So what does that mean? That means the advantage of being a seller has kind of gotten squeezed out. It's what professional traders call a crowded trade. Everybody's figured it out. Nobody wants to buy options because the market doesn't really go anywhere. Well, I'm talking about the broad market and a lot of individual names. I mean, don't get me wrong, there's still some pretty volatile high flyers, If you would have bought calls in NVIDIA at the beginning of last year, you would have done pretty darn good. If you bought calls in the S&P 500, you probably would have underperformed because time decay would have eaten up a lot of your delta profits. So it's very important to understand that if I'm going to sell something, I want it to be overpriced, right? This is like a classic concept in business, economics, trading. The only reason I would buy anything is if it's underpriced. The value that I perceive it having is greater than what I would pay for it. Right? Like if you're going to go out and you're going to buy a car, like a middle of the road car, a Chevy something or other, I don't know. What's a middle of the road car? A Ford something or other. It's listed as a $30,000 car. Well, if you're going to drive it every day, you're going to, you need to use it. It's going to provide value to you. It's worth paying $30,000. If that same car is $100,000 with all the same features, you're going to say, well, no, I'm not going to buy this. That's crazy. It's not worth that to me. So, that's sort of like an everyday example, allegory, I guess, of value. But that's exactly what option trading actually is. I think a lot of people don't think about it that way. But the only reason you buy an option is because you think it's undervalued. And that could be because it's a call and you think the stock's going higher, or it could be because volatility is underpriced and could go up and you can make money on what we call Vega. The only reason you'd sell an option is if implied volatility is overpriced, which historically it typically has been, generally speaking, overall, but not always anymore. So we need to be a lot more strategic than we've been in the past. Strategies to avoid. Time spreads are often tricky, though sometimes advantageous. They're advantageous in very certain scenarios. Earnings is one of them, for example, which is a very long explanation. But time spreads are tricky. We need to capitalize on the term structure of volatility, which is almost never present these days. Straddles and strangles are very tricky too, even though you can get them pretty cheap because implied volatility is pretty cheap. Historical volatility is cheap too. So you don't get the moves that you need to make money. And then for all you income traders out there, and I know there's probably a bunch of you, selling when volatility is too low. That is a common mistake of novice income traders. If there's one thing that's gotten easy to lose sight of in these markets, it's risk management. I have talked to traders who just started trading within the last couple of years, and they tell me how easy option trading is. I've never lost money on a single trade ever. I'm a genius. All I do is sell cash secured puts over and over and over again. Well, the market keeps going up, so you don't get assigned. It's been historically over the past few years almost impossible to lose money in the long run selling cash secured puts. But guess what? It's all changing. It's all very different. Now, I think there's a reasonably good chance that the rally we've enjoyed is probably going to continue on for a little bit. And cash secured puts could be okay. They're not as advantageous because implied volatility is much lower. But if the rally continues on for a bit, like I think it will, people are going to make money. But nothing lasts forever. This rally started back in 2009. That's 9 years ago. I don't know if we've ever seen a rally last this long. I'm not I don't look at figures exactly like that, but it's not going to last forever. Risk management is easy when nothing bad happens. There's a book out there called The Black Swan, and that explains the scenario that highly unexpected things happen much more than they're statistically supposed to. So, in 2018, we're going to have some surprises. And if you're just, short naked puts and you're not really paying attention and you're just not worried about risk management, there's going to be some times when you run into trouble. And sometimes, there's the potential that later in the year, especially, it could be big trouble. So we need to focus and trade more like a trader rather than, just kind of doing the easy thing. And it's not a big adjustment. It's just looking at it a little bit more sophisticatedly. and looking at some different strategies than what you've been trading so far, because when they stop working, you need to be an expert at a new strategy. Otherwise, your cash cow is gone. Stop making money. And then generating income based on the volatility environment, which we talked about, and which is ultimately the key to success as an option trader. So let's talk about planning trades. We need to plan basically two things when we make any option trade: planning which expiration and planning which strike. Now, the first thing, of course, we do is we, analyze our charts. And, I know we've got a really great panel of speakers here today, and I think some of those folks may cover charting, so I'm not going to, repeat anything that they're saying. You can maybe listen to them or use your own charting skills that you've developed over the years. But once you come up with a thesis for the underlying instrument, hey, I think it's going to go up over the next 3 weeks. Oh, I think this one's going to, crash. It's going to lose 10% over the next week. I think this stock is going to steadily grind higher over the next 6 months. That's your forecast. The degree of movement and a time horizon. And once you have the degree of movement and the time horizon, then something powerful can happen. Then you can construct an option trade that fits your specific thesis. We've put over, at Market Take, we've put over 3,000 people through our classes over time. And I do complimentary presentations just like this dozens of times a year. I've talked to, I don't know how many traders I've talked to, maybe 100,000 traders over the past, 25 years in my career. One of the biggest mistakes I see traders making is not fitting the strategy to the exact thesis. That, ladies and gentlemen, is your key to success. If you can do that, you can fine-tune your strategy so it exactly fits your market outlook. Your profits become higher. Your risk becomes lower. Your likelihood of winning becomes higher. Option trading, because there are many variables, it seems a little more complicated, but it's not that much more complicated. Sometimes people overcomplicate it, but it gives you many advantages. Because you have so many choices, you have more advantages. So if you're a new trader, don't get overwhelmed by, oh my God, there's all these strikes, all these expirations, all these Greeks, what are those things, this volatility thing I'm supposed to know about. There's a phrase, how do you eat an elephant? One bite at a time. You learn this thing and then you move on to the next thing, then you move on to the next thing, and there's not that many things. It's not that overwhelming, but ultimately what you're building up to is learning how to fit an option strategy exactly to your forecast. Instead of saying, well, I think it's going up, I'm going to sell a put, this one looks good, okay, done. That might have worked last year because the market just went straight up. But it's not real trading. It's not trading that gives you longevity and success and wealth in the long run. So let's talk about how to do that then, shall we? First, we need to plan which expirations. So first, the expiration you select should have some correlation with the expectation of the move. If I think the stock is going to rally 10% over the next week for some reason, I might look at an option that expires, a little over a week. Wouldn't trade a 2-day option if my forecast is a week out. If I think it's a year-long play, then maybe I do a year option, or I could come up with a plan to do, especially if I'm selling options, maybe I'd sell 1-month options and roll them month after month after month, so I can take advantage of being able to roll the strike and of getting higher theta, which we're going to look at in a second. The idea is short-term options tend to have bigger thetas. Oh, for those of you who are newer, what's theta? Theta is the option Greek that measures time decay. You know, as time passes, options lose value, all else held constant. But how much value? You know, you need to know exactly what that is. If somebody came to you and said, hey, I've got a great investment idea, give me $10,000 and you're going to make some amount of money. How many people are dying to get into that investment? Oh, I'm going to make some undisclosed amount of money. Yeah, that sounds great. Here's my cash. You know, no problem. Nobody in this room would do that. But I meet a lot of novice option traders who put on income trades and they say, oh yeah, you know, I make money as time passes. I say, well, how much money do you make as time passes? Well, I don't know, but you know, I mean, somebody told me I was going to make money as time passes. So that's why I sold options. Not really the way you should look at it, right? So we got to be a little bit smarter, a little bit more scientific as this market gets more complex. We need to look at exactly what our theta is. And what that enables us to do is say, well, if I sell this option, I make 50 bucks a day on theta, all else held constant. I might make or lose if the stock goes up or down or volatility changes, but I make 50 bucks a day on time decay, which is called theta, that number. But if I sell this option, I make $75 a day. Well, which one do I want? See, now you're able to make better decisions as a trader and make more money in the long run, which is key. And you know, some people say, oh, I don't care, I'm making money. But the fact is, you're going to have some losing trades that are going to erase some of your profits. Happens to everybody. Anybody tells you they've never had a losing trade, they're just plain old lying to you. Everybody does. And those losing trades erase winning trades. So you've got to maximize your winning trades and make as much as you can from them so that when you take a hit every once in a while, excuse me, when you take a hit every once in a while, it just takes a little bit out of your profits and you're making money in the long run. And then also selling shorter term options gives you a shorter period of risk. You know, for those of you who are familiar with cash secured puts, like if a stock is at 55 and I sell the 52 puts, if it, you know, the concept, even for you new folks, is if the stock goes down below 52, I'm in trouble. Well, if that's a one-day trade, I'm probably not too worried about it. If it's a one-week trade, I'm maybe not too worried about it. If I've got to hold that for a year, well, sure, the stock could fall $3 in a year. The longer I hold a trade, the more anything can happen, which is intuitive. So we like the idea of trading shorter term options and then rolling them. And then planning our strike. For cash, for covered calls and cash secured puts, we make those conducive with the target price of buying or selling the stock. We should want to get assigned. Now that's the opposite of how some novice traders look at it. A lot of traders say, oh, well, I'm selling these cash secured puts and, you know, it's free money as long as I don't get assigned. If I get assigned, you know, it could be the end of the world. Oh my God, what am I going to do then? Well, what I do often is as soon as I get assigned, I'm happy. Sometimes I end up buying above where I could have bought otherwise. But what I do is I immediately turn around and sell covered calls. That's one step in a larger strategy that we teach at Market Taker. And then credit spreads. I like to set my short strikes on the far side of support or resistance. Okay, so I'm telling you here about this thing about selling shorter term options because they have higher theta. But I don't want you to just believe me. I want you to see it in black and white. So look, let's say I'm selling the 200 strike puts here at 277. Now these are 9-day options. The theta is 0.1279. What does that mean? Well, that means that all else held constant, these options lose about 13 cents a day. Now, these puts, if the stock goes up or down, they might make or lose money on delta, but as time passes, they will decline in value by 13 cents. And if I'm short them, that's exactly what I want to have happen. But what if instead I chose the 16-day options? Now, selling those 200 strike puts, holy cow, it looks like I get more, right? I can sell those for $3.35. I make so much more money. But that's actually a fallacy. It's a very, very common logic trap that traders sometimes get into. Because, in fact, you're only making about 10 cents a day in theta if you sell those. Now, you might say, well, wait a minute, but still, this one's worth more, so I'm going to make more. Well, guess what? What if you sold these 9-day options for $2.77? And then when they expired, on expiration day, you close these for a penny or something, and then you sell a 7-day option for $2.50 or something, which is probably conducive, right? 9 days to 7 days, you know, 27 cents less. That's about exactly what you'd sell them at if the underlying stock was in the same place, you know, all else held constant. So you'd make about $5.25 if you sold the 9-day option and rolled it to the 7-day option instead of $3.35. So no, even though this number is bigger, and on the, you know, very superficially, it looks like, oh yeah, I can make more money. You're not going to make more money. You're going to make much more because the theta is higher by selling the short-term option and rolling it. And then we're going to look at the strike target. So this is what John spends an hour every single day in our group coaching class. John's the guy who's in the picture who goes to China with me yearly to teach their exchanges and traders about options. This is what John does every single day in our group coaching class. He pulls up charts and he looks at them and he looks for pivot points and other data points. And he designs trades that are specifically priced around support and resistance and volatility and time horizon and all that. But if we identify a resistance level, for example, here's a resistance level up here. What is this? 220, 225, something like that. Just an example. If I can sell a credit spread with the short strike price at or above 220, you know, the resistance level, that actually increases my chances of winning above and beyond other smart things that I'm doing. Why? Because if the resistance level holds, then the stock doesn't go above resistance. Resistance levels are called resistance levels because they hold somewhat more often than not. Now, when I say that, maybe that's 55% of the time they hold, you know, instead of like 50-50 means who knows, could go through it, could not go through it. The chances of resistance holding are slightly better than not. So guess what that does? It slightly increases my odds. I'll take slightly increasing my odds. If I'm running a race, you know, a 50-yard dash, if somebody gives me a 5-yard head start, doesn't guarantee I'm going to win the race, but my chances are better. Every little tiny, that's what good trading's all about. It's taking all these little advantages, putting them in your favor, and they all add up. Nothing guarantees a winner, but if I have a whole bunch of advantages, I'm going to have way more winners than losers, and I'm going to make money in the long run. So that's a very, very key element to credit spread and cash secured put and covered call trading, and some other types of trades that you know John covers every day in our class. So as far as planned cash secured puts and covered calls goes, it's not market timing, it's market planning. Hey, I'm happy to get assigned. It's not picking bottoms or tops. I'm going to be wrong plenty of times. If I get assigned, I'm going to be wrong plenty of times. In fact, if I get assigned, I'm wrong. But this strategy If you do it once, then, you know, it's kind of just gambling, hoping to get lucky. But if you do it week after week, month after month, year after year, collecting all that premium over time, statistically has been shown to way more than make up for any losers that you have from when you get assigned. So it's not just premium generation, it's a way to get in or out of a security via assignment. Now, how often can you find trades like this? All the time. Some market periods are better than others, but every single day there is an opportunity. It might be a different opportunity than it was yesterday, last week, last month, last year, because the market's always changing. But the more, again, the more you learn, the more you earn. So what we talked about here today is a simple series of steps using support and resistance, volatility. I didn't mention this, but with credit spreads, you always want to avoid earnings. And trading can be great. You know, I like to show this slide sometimes because I hope it to be like empowering to you. I know a lot of traders who the only job they've ever had in their entire life is trading. And a lot of them drive nice cars and have big houses. You can be successful as a trader if you commit to learning more about trading. You can earn the right to do whatever you want to do. I mean, these are some of my hobbies. I like to travel, I like to play music, you know, insert your own pictures here, whatever it is you like to do. You can have a nice, relaxing, you know, good life as a trader. So here's what we covered today. The MTM Trading Plan for 2018, strategies most likely to work. Obviously, these are 45-minute presentations. We like to spend more time with students, so we didn't have time to talk about everything. We didn't talk about scanning for income trades or which strategy to use under different market conditions, you know, how to adapt to changes in the market, blah, blah, blah. But that's okay, because guess what? We've actually got a class, and I referenced this during the presentation. It's called the Market Taker Live Advantage Group Coaching Class. And in this class, it's led by John Kamisic. He's the guy that, again, he's our head coach. I've gone to China with a number of times. Ex-Goldman Sachs guy, by the way. He's going to share with you the techniques we use at MTMs to set up credit spreads, optimize covered calls and cash secured puts so you can stop guessing on bound to fail trades and generate consistent, low risk income. This is for anybody who wants more consistency in their traders, more frequent winners, traders who can follow a few simple steps and believe their trading success is tied to a methodology. Not a get rich quick scheme. This is not, so this is like this middle bullet point here is kind of important. It's not for indecisive traders. Sometimes I talk to traders and they say, I don't know, is this going to work for me? And the answer is yes, this can work for everybody if you're capable of making decisions and what I call pulling the trigger and doing it. Like some people have analysis paralysis, they just can't make a decision, and you know, you're not going to succeed as a trader. But if that's not you, if you've made some trades and you have the ability to, you know, to actually execute a trade, this can be a great class for you. You get trade ideas every single day in this class. John gives about 10 trade ideas in the live market. The class is from 9 to 10 Central Time. That's 10 to 11 Eastern Time. He gives you these trades, but more importantly, like it's not just like an alert service, like here, go trade this, trust us. It is, hey, look, here's a chart. He'll show you the chart. It's a webinar. It's webinar style every day. So you log into the webinar, John pulls up his platform, says, look at this chart on Apple. See this support and resistance here, see the volatility chart, see the Greeks. And if you're doing that, even if you never trade any of John's trade ideas, you're learning so much because you're learning exactly how a professional thinks about trading, and you're learning about all these things that maybe you're not familiar with yet. So some people attend the class just to trade the trade ideas because, you know, John's an ex-Goldman guy. He's been doing this almost 30 years. But then some people trade it just to kind of be put in the mind of an ex-Goldman guy who's been doing this for 30 years and learn, you know, how professionals think about option trading. So they're all live every single day for an hour a day from 9 to 10 Central, but they're all recorded too. About half the people who enroll in this class never attend live. They watch the recordings when it's convenient. You don't need any special software. The webinar you're watching right now is on GoToWebinar. That's what we use too. It's a great, easy to use platform. This class is good for ETFs, stocks, even, commodity options. So when you log in, you're going to get this, and you're going to get the last 3 weeks of recordings, but you're going to attend this class every single day for the next month, and I'm going to give it to you for basically just a processing fee. Go to markettaker.com/GC49. That's this website up here, markettaker.com/GC49. The class is usually that's our old price, it's higher now, $349. We're going to give you the Options Impact video series, so if you're new to options, you're going to learn a ton, and unlimited email access to us, the email hotline, which we sell for $1,000 on our website. 1, 2, 3, go. It's $49 today. And again, for this $49, you're going to be in this webinar style class every single day for a month. You're going to get about 10 trade ideas every day, and you're going to learn an insane amount. This is, for $49, is your best bet for taking your trading to the next level. I think I'm able to answer questions. So if you have questions, would you please answer them, or please ask them and I'll answer them? How about that? Any questions? Any questions? I'd love to help you out. We kind of covered a lot today. We do still have 4 minutes. I can expound on anything that we covered. I'll tell you that when you enroll in this class, basically you get immediate access to the archives. You can watch today's archive since you missed it, and you're in the live class tomorrow. And again, the way you enroll is markettaker.com/GC49. Well, not having any other questions, and I got a couple minutes, so why don't I do this? Why don't I just kind of give a couple of parting words of advice while I'm waiting for questions to come in? And before I told you that probably the biggest mistake that I see traders having is they they learn one strategy and they kind of execute it. They put on the strategy in a not very scientific way. And don't get me wrong, look, you don't have to be a scientist, you don't have to be a genius to trade. You just have to learn a couple of generally accepted principles. And when the strike price that you select greatly influences your profitability. In fact, I'll tell you what, I've done some looking around and done some, in some of our own webinars, I've talked to different students and said, what are some trades you made? And I'd find some people both made the same trade roughly. They were both bullish on who knows what, Apple. And one trader made money and the other trader lost money. They're both bullish, but they traded it different ways. Maybe one bought calls and one sold a put credit spread. Maybe one traded a covered call and one sold a cash secured put. One did a back spread, one did a bull call spread. So strategy selection, strategy construction ultimately becomes the key to your success. And that's why we think it's so important over here at Market Taker. That being said, I really appreciate your time. I hope you learned a lot. I tried to give you everything I could. Glad you were able to join me. It was really great to meet you, and we hope you'll hear us again sometime in the future. Trade well and have a great day, and stay tuned for some more great speakers.